Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We're going to get right to this right now. Dan Ives joins us from Wedbush here, all over the media, of course, as we go into the Mag 8 frenzy. Warren Buffett, he's part of the Mag 8 right now. 65 buys on Nvidia, 8 holds, no sells. Now, you don't follow Nvidia. You've got a thug at Wedbush that follows it, right?
Yeah, so our view in Nvidia, we have $138 price target. Bull case is $175.
Bernstein went to $150 this morning.
And I think this is just the start. I mean, look, I think this, by the end of the day, or even in the next 24 hours, this is a stock that should be in the green based on everything we saw from Godfather of AI, Jensen Nvidia.
Paul, get one more in here. On
I will. So Dan, give us a sense. What did you hear from Nvidia last night? They beat numbers. Maybe the guidance wasn't where the street was expecting, but what did you really take away from Nvidia last night?
So 3 things. One, demand. Because the question is there double ordering? What is enterprise demand? Demand's actually accelerating. And there's no better perch in terms of everything we're seeing from AI than what Jensen sees. 2, Blackwell, all the fears, right? The worries. Is that getting delayed? They essentially put those fears to rest. And that was so important.
Okay.
You know I'm the only one that does math with you, not all this fancy Dan Ives talk. You take the 10 billion share buyback of Apple, they've been doing it for years, divided by free cash flow. You take a 50 billion statistic divided by Nvidia's free cash flow. To me, it was a ginormous announcement. Everybody's saying it's not a big deal. Was a share buyback a big deal?
It's a monster deal. And also, this also goes to a company you go back 6 months ago, out year by 25, 26. People thought $2 in earnings. Now it's going to be $5 to $6.
Extended time here this morning with Dan Ives. We welcome you all around the world on YouTube, on Android Auto, Apple CarPlay as well. Okay. I go to Apple, I go to the famed aggregation of Tom Secunda in the Bloomberg News, and I'm just going to read these, Paul, quickly. Mashable. Apple Music playlist now transferable to YouTube Music. University of Wisconsin denied new trial as they go after somebody. Apple orders 10% more iPhones than last year. Apple iPhone 17 rumored to arrive at the Sweeney house before September 15th. And on the last headline, Dan Ives on Bloomberg right now. I mean, here's the news out of Tokyo. Shock. There's more iPhone orders. How do you translate that?
I mean, this is the start of an AI-driven super cycle with iPhone 16. I think it's going to be a historical period. Look, we've talked about a lot on the show. 300 million of 1.5 billion iPhones, including Sweeney, haven't upgraded in 4+ years. AI, 25% of the world is going to access AI through an Apple device. The consumer revolution all starts.
I'm going to push against you. Tom Keene and Paul Sweeney don't give a damn about AI. We just want an iPhone to know where our kids are. What's the big deal about AI if Paul Sweeney's not going to use it?
So that's today. If you look at there's going to be hundreds of apps built on Apple Intelligence that are going to be AI driven. As well as this open AI, it's essentially going to be a personal assistant that really, from a data perspective, understands Paul Sweeney, understands Keene, understands your habits. This is going to change. This is how most consumers are now going to interact with AI.
Right. China. What's the latest on China? My concern, always in the back of my mind, is the average Chinese consumer is saying, I'm just not buying American. Is that an issue for Apple in terms of market share?
I mean, as someone that spends time in the region, the average Chinese consumer wants the best product in the world, which is an Apple device. So I'm not saying that there aren't some geopolitical headwinds, we're actually seeing more tailwinds out of China, especially with iPhone 16. You have 100 million iPhones that are basically have an upgrade in 4 years. So I think any headwinds there have started now become tailwinds. That's why I cook 90% CEO, 10% politician.
Right. Yeah, it's smart. How about India? I was just talking about this with somebody at the club last night, Tom. At the bar, we were talking iPhones in India. How that came about, I have no idea.
John Tucker, were you at the club last night?
There's no club that would take me. Nor would I want to be in that club.
Or were you at the watch party for Nvidia?
Oh,
Yes, exactly.
Yeah, Weisenthal was that sad or whatever?
Yep, exactly.
I thought Sweeney was going to be at that watch party.
I did too.
I know.
He's day trading off his couch at the cottage. I can only say my club last night, I was at Club Do the Dishes. Continue, Mr. Sweeney.
India. What's the opportunity there for Apple in India? Don't they have to have a lower price phone in that market?
Yeah, but in India, you've actually had a rising middle class. And I think if you look, that's always been a tough market for Apple. 3% iPhones, we think, call it by the next 2 years, it's going to be 10 to 12% overall iPhones. India is actually going to be robust for Apple, especially on different price points.
How many iPhones are purchased, a wise one, on a plan from a phone company, and not where somebody spends $800 or $1,000 on the toy?
I mean,
it's a huge number.
I mean,
right?
it's a huge number, and if you look at the carrier discounts, that's going to come. And this is the big thing.
Do you have information on them you'd like to break on Bloomberg Surveillance this morning?
Look, everything we're seeing, we think it's going to essentially be unprecedented types of promotion from especially U.S. carriers.
Verizon, AT&T,
T-Mobile, just because this is the time. In other words, when you think about 5G, when that came out, and now essentially AI, this is really going to be the opportunity in terms of carrier discounts. And what really starts, you talk about maturity on a smartphone cycle, this is now that consumer AI revolution that actually will go through Cupertino. And we think that's how we have a $4 trillion market cap as we go into early next year.
Do you have some of the parts on Apple you can update for us?
Yeah, so
right
we have
now?
1.7 trillion is what I view as the services value. And when you sort of some of the parts that's something where you got about 100 billion of rev growing mid-teens, free cash flow margins are double the hardware business. You combine it, it's over 4 trillion. I think bull case is ultimately over 300.
Microsoft, I know you've been very bullish on Microsoft. What's the thought these days?
You look at Nvidia's call last night, you also buy Microsoft because Nadella and Redmond are leading that on the software side. You look at OpenAI, they're really dominating in that Mount Rushmore. That's where Nadella is along with Jensen.
Does Blackwell compete with Azure? Or do they cohabitate?
They're complementary. And think about Blackwell.
I don't understand that. Explain that.
So essentially, Blackwell is almost the architecture, the foundation of a house. Microsoft is the actual house. The actual rooms will be different software players, ServiceNow, called Salesforce and others. What protects the house? Cybersecurity, names like Palo Alto and others. Look, I continue to think, NVIDIA today, it's LeBron in high school. That's essentially where they are. LeBron in high school. NVIDIA, that's where they are.
So I guess when we think about this AI spending here, the numbers are just almost numbing. They're so big. How much of the AI capital spending is it incremental versus just taken away from other tech budgets like IT or something like that?
So I'd say about 800 billion of the trillion is incremental. So there's 200 billion that, of course, there's a cannibalization impact and there'll be losers on that. But it really is incremental. And it just speaks to strong will get stronger in tech. And then you can talk about regulatory. Regulatory is in a minivan going 40 miles an hour in the right lane. And the technology is in a Ferrari, Keene the Ferrari, left lane going 100 miles an hour.
What is the free cash flow growth of the Mag 7? When you aggregate them together, there's a secret Excel spreadsheet in the basement of the Ives house.
Free cash flow growth of Mag 7 is, I'd say, upper teens into potentially 20%.
Really? You're going to give me a 2-0 on it?
I think it could start to now get that high as we go into next 2 or 3. And that's why, look, I get it. The Bears continue to, they sit there with their spreadsheets, DCF being negative on tech.
But I'm going to stop there. This is too important. You're going to DCF. I asked this of Paul yesterday. How do you do a terminal value on these juggernauts. This is not CFA 101.
But you have to ultimately trajectory out what the CapEx looks like, what's the incremental dollars, and what that ultimately means to the long term.
So how far out does Dan Ives go?
You basically have to go out 6, 8, 10 years to actually do a trajectory. Like when you look at Microsoft, the way that you get 4.5, 5 trillion, okay, you have to basically say how much a percentage of CapEx they're going to get, what the monetization, what does the free cash flow incrementally look like, and that's where all these stories change. But then there's other names like a Palantir, the Messi of AI. It wasn't even on the radar. Now
they're LeBron and Messi into the same.
They're a core AI play.
Hey, Dan, one of the key attributes of your research is that you travel the globe. Yep. You see people all over the place. What's your next trip?
So we'll be going to Asia on Monday, be there for 2 weeks. And look, to me, that's where we get an edge, because I think a lot of investors, how they've missed AI revolution, they try to find it on the Metro North, Jersey Transit, on the 10th floor of their office building in New York or San Fran. You got to travel to see it, and I think that's...
So what do you see when you go to Korea?
We see the suppliers, we see the component players. I also think by seeing global investors, you get a very good sense in terms of where things are. And I think it just gives you a little more perspective.
Final. Can you convince John Tucker to upgrade this time around?
No, I think
the flip phone.
Look, I think Tucker, after going to the Nvidia watch party last night, that he might now potentially upgrade to an iPhone.
It occurs to me, Blackwell chip. Where have I heard that name? Remember Mr. Blackwell, the guy who did the best and worst dressed list?
Oh yeah.
Where would Dan come in on that list?
Another sophisticated.
I think Keene would be at the top. Keene would be at the top, and I'd be in maybe like the other category.
And safe travels, hugely valuable. We'll of course feature Mr. Ives, Mr. Munster together today on Bloomberg Surveillance. That's the way that we roll. Blerina Urici joins us right now from T. Rowe Price with their wonderful academics out of Beth and LSE as well. Blerina, we had HSBC in here, I think it was yesterday, day before, with a brilliant separation of the consumer in America, not east-west, right-left politics or anything, but the haves and the have-nots. How polarized is the American consumer?
I think there are a couple of ways in which you can characterize this. One is the fact that the savings buffer and the balance sheet of the consumer at the bottom, 20 to 40%, is significantly weaker than the rest, more well-off consumers in the economy. They ran out of pandemic savings sooner. They didn't build their cash buffers as much. And also the other thing that has been hitting the lower-end consumer more than upper-income quantiles is inflation. We know that this proportion of the economy spends more on necessities like food and energy, gas at the pump station, and this is where inflation has hit the hardest. I think what has compensated a bit for this hardship in terms of inflation and cash balances has been the fact that the labor market has been so strong and so hot that income growth and wage increases have been higher for those workers at the lower end of the scale or the lower end of the income distribution. So we've seen average hourly earnings for retail hospitality increase more than other services parts of the economy.
So, Blerina, what did you make, given that backdrop of, this economy is still pretty solid position, but the Fed on Friday out in Jackson Hole, Fed Chairman Jay Powell seemed to really signal that they are open to cutting rates as soon as September. Does that seem reasonable to you?
So I think this has been, he telegraphed pretty well that September is now a done deal. And I think for the markets, the question is what will be the size of the cuts initially and the pace going forward. We still don't have much clarity about the terminal rate in this business cycle, and notable that Chair Powell again did not comment on R-star and equilibrium interest rates. So I think we have a bit more uncertainty about the pace of cuts and the terminal rate, but we're starting the cutting cycle. To your question, is this the right thing? Why are we starting to cut interest rates at this point? We go back to the labor market. When you look at the July payroll report, we're talking about the magnificent sevens in the stock market. We have a magnificent five in the labor market with government, education, health services, retail, hospitality, driving about 100K of the job increase. In total, the economy produced 114K net jobs. So you see how much of job creation is being driven by this subsector. And I think the Fed is worried that tight interest rates or high interest rates are restricting growth in the other more interest rate sensitive parts of the economy. And that's why I think they don't want to be behind the curve. They want to start that easing cycle to make sure we don't have a more abrupt labor market correction.
Okay, I'll go there, but give me the horse in the cart, Blerina. This is what you do when you've amassed some LSE. You nail the horse in the cart. Blerina, give me the horse in the cart. The bond market's clearly signaling price up, yield down. Not like China. It's a different story. Is the bond market ahead of the Fed, or when the Fed cuts, do we get further price up, yield down in bonds?
I think the market is ahead of the Fed. My view is that we do have some softening in activity and some loosening in the labor market, but the economy is not weak. And so what we're seeing in this business cycle is that the market gets way ahead of the Fed. This happened back in December, January as well. That loosens financial conditions, and in some way it provides a bit of a positive impulse, growth impulse to the economy. I think we're doing that again now, but the economy overall is not weak. I don't think we are about to enter a recession. And so the market, I think, has gone ahead of itself, is probably pricing in more cuts than the Fed needs to deliver. Now, let's be clear. I think the Fed wants to start easing monetary policy, wants to bring interest rates in a place where they are more balanced, not as restrictive as they are right now. But I don't think that they'll go all the way to where the market is in the next 12 months.
Blerina, we had you mentioned you were talking about the labor market here. We had the SOM rule, presumably indicated that we're in a recession. Does that seem reasonable to you?
I mean, this is a very interesting question. It's Chair Powell characterized it as a statistical normalcy, something that has tended to happen historically. And it's very unusual that this time around, we're seeing this type of increase in the unemployment rate with the economy being as strong as it is. Historically, when the unemployment rate has increased so much, we've had negative consumer spending growth. We've had weakness in industrial production, much more pronounced than where it is right now. So I think there is something here. We need to take signal from the loosening in the labor market, but I don't think that the predictive power of the SOM rule this time around is as powerful as it's been in the past.
Blerina, thank you for the brief this morning. With T. Rowe Price, Baltimore, the Blerina Urici with us. Joining us now, who does better math than me, Sarah House, US Economist at Wells Fargo. Sarah, excuse me, am I off the mark to take 3% real GDP, add in a GDP price index of 2.5, and I've got nominal GDP above 5%?
That's how you do it. You're the math whiz, Tom.
Well, what's its signal?
Right.
I'm sorry, that's a solid economy. That's morning in America.
Right. No, it still signals that the U.S. economy is in very good shape. I think that upward revision in consumer spending is pretty telling, that even, I think, with some of the slowdown in income growth, it doesn't seem like there's much to stop the U.S. consumer as of now. So still looking like pretty good momentum as we head into the third quarter. And I think as we look ahead, though, still expecting a moderation, just given that in some ways, well, despite all the strength, it is difficult to sustain, I think, given that income backdrop.
Paul wants to get in here, but let me just finish the thought. Let me close the loop. What is the Wells Fargo microdata of the quarter ending September 30?
Yeah, so we're looking for a step down in consumer spending, even as you did get a very strong start to the quarter. So we saw that in the July retail sales. We're expecting another pretty strong print in tomorrow's personal spending numbers. But I think as we move through the quarter, this downshift that we've seen in job growth, the downshift that we've seen in nominal wage growth. The fact that the excess savings from the pandemic have run dry for most households, and also credit growth is running below inflation for the consumer sector. It does mean that I think this, almost 3% pace of consumer spending that we saw in the second quarter isn't going to be maintained.
All right, Sarah, given that backdrop for the consumer spending, given the backdrop of the GDP print we just saw today, how do you put it in context what we heard from Fed Chairman Jay Powell last Friday in Jackson Hole, that the time has come for policy to adjust?
I think that's right. So when we look across the U.S. economy, again, the consumer is still spending, but the fundamentals are weakening. And really, when it comes down to the consumer, it's increasingly important what's happening with the jobs market. And so I think given the moderation that we've seen in hiring, so forget even the backward looking benchmarks, but even just over the past 4 months where you've seen hiring at just a little over a 150,000 pace, what we're seeing in terms of the increase in the unemployment rate, not just the temporary layoffs, but the permanent job losers, that the labor market has softened quite a bit. It's back to where it was before the pandemic, if not a little bit softer. So if we don't want to see the labor market break, it's time to dial back the degree of restrictiveness that we currently have Fed policy at.
Do they dial it back by 25 basis points or 50 basis points in September? And does that even matter?
So coming out of the jobs report that we got on August 2nd, we thought that they would perhaps go 50 basis points. That's still our current call, but I think it's really going to come down to what we get out of the August jobs report on September 6th, given that you have seen, I think, some of the activity data hang in there better. Claims have come back down as we saw again this morning. But also, I think you just haven't heard, I think, that appetite from the FOMC, other members of the committee. So I think it's going to be really hard to get a 50 basis point cut at this point, unless you see a sharp weakening again in the jobs numbers coming out of the next payroll report. But I think it does look pretty clear that they will be cutting to some degree. It's a bit of a taller order for 50, I think, based on some of the data and Fed speak recently.
Sarah, one of the themes this week for us is this sharp dichotomy in consumption. 70% of the economy between the haves and the have-nots. You guys do immense work on this with the Wells Fargo Heritage. What is the polarization? Rather, not that. What is the polarity or barbell of the American consumer today?
Yeah, it is pretty stark where, I mentioned some of that excess liquidity and estimates show it's run dry for your lower end. And I think you are seeing that stress when we look at things like delinquencies among credit cards and autos are at the highest going back since we were coming out of the financial crisis. But again, you're still seeing in aggregate putting up pretty strong income and spending numbers because the upper echelons are still doing pretty well. So they're benefiting from still being employed. They're benefiting from wealth increases that we've seen coming out of the housing market and financial markets as well. And so that's been able, I think, to mask some of the ongoing stress that we've seen at the lower end and keep consumer spending positive. Even as we have seen, I think, some of the jobs numbers weaken, and also just a slowdown in average hourly earnings at the lower end of job earners.
Sarah, this is a big picture question, but thank you. This is a big question, big picture question, kind of, Sarah. The deficits, the national debt. I mean, do I have to worry about this in my lifetime here?
So this is something, I don't think there's a crisis moment. There's no, set debt to GDP that all of a sudden things go sideways. But I do think that the trajectory that we've seen, it is concerning when we think about the rising cost of interest on the debt and what that means for other forms of spending. So particularly when you think about all these budget battles that we have each and every year, and we can't get a budget passed on time, we're fighting over a very small piece of the total spending pie, that discretionary spending, whether it's defense or non-defense. And as that interest cost increases, as well as you have the upward trajectory in the mandatory entitlement spending, I think it does make some of those battles and even more contentious. And I think you have perhaps less productive investment from the U.S. government. So there's no crisis moment, but I do think it has some erosion in terms of the U.S. economy.
Sarah, I'm putting it on Twitter and LinkedIn now. Something I did, I don't know, on the trip back from Jackson Hole. Paul Bramo took the Gulf Stream. Took me like 3 days to get back.
I know.
I was on a covered wagon outside, Cozad, Nebraska. Sarah, at the Brookings Institute, Peter Orszag of Lazard, Murdoch of Lazard, and Robin Brooks put together a 3-part essay which says, everybody calm down. Most of what we're talking about was the duration, the length, the unknowable of the effect of the pandemic. Do you buy that?
I think so, in terms of, I think just how long it's taken us to normalize has been a lot longer than anyone expected. I think we saw that up from the transitory issue of, we knew that there were a lot of distortions caused from the pandemic. I just think it was underappreciated how long those would last. I think we've seen this in terms of just the financial position of households coming out of the pandemic, given all the support we had, the tail of how low rates were early on that allowed a lot of people to refinance their homes and haven't felt the impact of higher rates. And so I think we, in this more instant gratification society where everything's moving so fast, I think it's been difficult for us to wrap our heads around that. It does take time for, I think, some of these effects to unwind, and it's something we're still grappling with here in mid to late 2024.
That's the camp I'm in. Sarah House, thank you. So I'm in the Sarah House campus.
Oh, yeah.
Yeah, Wells Fargo. Thank you for that. Gene Munster joins us here on the technology of the moment. Gene Munster, I want to go bigger, broader with you because we sort of beat to death, the minutia news and all that on Nvidia or more iPhones out of Nikkei saying Apple's doing better. Scott Galloway is one of the wisest people I know. And in some interview, Gene Munster, Scott Galloway said basically the single most important thing in his life is he's never listened to people who said, sell Microsoft, sell Apple, and now sell Nvidia. Time magazine, Norman Seff, the famous photograph, 1984, of Steve Jobs cross-legged on a living room floor with that ugly Mac. The rich kids owned it a million years ago. How does Gene Munster react emotionally when it's out there, these tech juggernauts, sell Microsoft, sell Apple, sell Nvidia?
Well, I think how I think about it is just what's the long term. You got to think the long term play, and there's the near term, and that's what's the vortex that's going around Nvidia today. And I generally react to a view of where the world is going. In the case of with Nvidia, it's a belief, a strong belief. I'm staking my career that AI is going to be having a bigger impact than the internet. And if that's the case, this trading around Nvidia today is largely noise, even though it is a $3 trillion company. And the reason why I still am comfortable and think of this in that same class as Apple and Microsoft is that ultimately is if you believe that AI is going to be as transformative, more transformative than the internet. And there's a second belief you have to have is that the way to get there is through scaling laws, which basically say you have to throw more compute and data at the problem to solve for intelligence. Then NVIDIA is going to be a winner. And I think that it is in a great place. I do want to add an additional angle to the context of just buy and hold forever is that Deepwater, we own NVIDIA. I think the next 2 years are going to be far better than what people are expecting today. But at some point, when you're a hardware-only company, there is a point of deceleration that needs to be taken into consideration. And I think that 2 years, 3 years from now, this may be a position that will trim. But we think today is the time to own it.
Gene, when somebody like you, Gene Munster, says they're staking their career on this, that really, really resonates for a lot of our listeners and viewers. Gene, can you just remind us how you view AI in the context of the internet, electricity, stuff like that? Because that really hit home when I first heard you say that.
So, I guess those that believe that this is going to be transformative kind of struggle for the right analogy. Is it the internet? Is it mobile? Is it electricity? And at the core of humanity is intelligence. And the concept of having intelligence in real time at scale is something that it's hard to put a value on it. I think it's much more valuable than connecting machines and connecting data. As powerful as that has been, I think intelligence is a more powerful aspect to it. And so there is a huge missing piece around the substance of what does that actually mean? Like, how is that going to impact our lives? And the use cases and the examples have been few and far between about how AI is like profoundly impacting our lives. And I just want to give one quick example. If we would go back in a time machine in 95 and be talking about the potential of the internet, we could easily frame out that Facebook was going to happen with social connecting over the internet. We could see that Netflix was coming around the corner with video over the internet, but it would have been impossible for us to understand that the smartphone was going to come because that was obviously enabled by the internet. Those kind of second and third derivatives. And that's kind of similar to how I think about AI more broadly. And I'm not concerned that we don't have these killer use cases today, because I think that those will present themselves as we reach closer to general and eventually super intelligence, which is where it really gets like crazy.
Were you surprised by the iPhone build out reported by Nike today? Nikkei in Tokyo. Did that surprise your team, Gene?
I'm not surprised. I think what is most important is that when I think about this next iPhone cycle, it comes back to this belief, and do you think that these features are going to be exciting for people? And I don't worry about what kind of the near-term builds are, whether they're positive or negative. What I think about is, are these features people will want? And I just quickly I look back over kind of the last 17 iPhone cycles and try to compare what these AI features are going to do for demand. And I think it's similar to the iPhone 6 Plus. That was the first large
That's what you have now, Paul,
iPhone.
Right?
Oh, yeah.
You have the iPhone 6 Plus?
Yeah, I think so, but I'm upgrading soon, Gene.
That's good. You're right there. You're only 10 years into it. It's time, Paul. But the iPhone growth went from 12% for the iPhone 5 cycle to 52%. I mean, it had a profound impact on how people got excited about these devices. One more quick thought about how I think about the next cycle is that if we look at the total number of iPhones that are out there, there's about 1.5 billion active iPhones. The life is just over 5 years, average life of an iPhone. And if you take the next tranche, so take not the one that typically upgrades this year, but the one that's going to typically upgrade in late 2026, and you assume 10% of those, just 10% of those see these AI features and say, yes, I'm going to buy it a year early. The iPhone growth goes from 7 to 15%. And so the sensitivity around just getting a small piece of that massive pool to move forward is going to have a measurable impact on the business.
Gene, thank you. Gene Munster with us.
Thank you.
Today. Really, really appreciate it.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.